Joining us in an exclusive interview is Ryan Marshall. He is PulteGroup's president and CEO. Also, our very own Diana Olick. Let's start with, Ryan, the numbers, what came out today. Obviously, numbers beat expectations, but the big question so many people have is what's happening to demand as mortgage rates climb north of 8%? What have you seen?
Well, good morning. Thanks for having me. We had a great quarter, and it adds to what's already been an extraordinary year for the company, thanks to a strong operating model and a wonderful team. A few of the things that I think I'd highlight for our quarter that we're particularly proud of is we saw great demand. Our new orders were over 7,000 for the quarter, which is on a year-over-year basis, nearly a 43% increase. Certainly, things have gotten more difficult in a high interest rate environment. But candidly, we've been facing that for the majority of the year and for, really the last 18 months. And I think we've demonstrated that we've got the ability to operate in that type of environment and deliver great results for the shareholder.
Yeah, obviously, there's huge demand for home ownership, especially when you think about the supply that's out there. That story is one we've talked about again and again. But we have seen the home builders offer incentive plans to try and help consumers. Is that just an exercise in things getting so expensive because of those higher mortgage rates?
Well, that's exactly what we're currently dealing with, and offering incentives is nothing new for the company. What we've been able to do, and it's worked out to be quite a competitive advantage for us, is we've redirected the incentives that we're offering toward things that matter most to the consumer right now. Historically, we've offered those incentives on things like countertop and cabinet upgrades. Today, the consumer needs those incentives towards mortgage rate buydowns. In fact, right now, as a company, we've got a national mortgage rate incentive program that offers a 30-year fixed mortgage at 5.75%. So in an environment where affordability is challenged, we've got some unique tools to help solve that affordability pinch for the consumer.
And Ryan, I wanted to talk to you a little bit about those mortgage rate buydowns, which a lot of the big builders are doing. How much is that going to eat into your margins next year? Because you've had some lower costs this year when it comes to the price of lumber that might have offset and allowed you to do those buydowns. But as we go forward and rates are now over 8%, whereas when this quarter was reported, they were just hovering below 7.5%. How is that going to eat into your bottom line?
Well, it's a great question. And what we've been able to do for really the last 12 months is offer incentives that have been directed at buying that mortgage rate down. Those incentives have been and are embedded into the gross margins that we've been delivering, as well as into the gross margin guide that we've provided for the balance of the year. So it's really embedded in the margins that we've reported. We continue to have industry-leading gross margins. This most recent quarter is a great example of that. We just reported gross margins of 29.5%. So, the incentives the rate that we've offered, as I mentioned, right now is at 5.75% on a 30-year fixed, and that's incorporated in that margin guide. So we feel pretty good about our ability to continue to deliver profitability while still solving affordability.